partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast number 314. This edition of the Moving Iron Podcast is brought to you by Machinery Scope and Machinery Finance. I've got Troy Vosberg here from Machinery Finance, and we have got a lot to talk about today, Troy. There's no lack of stuff to talk about. It's talking about what we see happening in rates and all those kind of things around us. So how you been, man?
Good, really good. Just again, I think just trying to get used to this rising rate environment out there, but I think everyone is. So
yeah, that is an understatement for sure. So talk a little about Machinery Finance, Machinery Scope, what that is, and where folks can find it at.
Sure, definitely. We're based here on Alexandria, Minnesota. Been on the Machinery Scope side, which is actually our extended service contract division, which I'm sure a lot of guys are familiar with out there. Been in business here for about the last 8-9 years anyway, and offer extended service options for all ag dealers out there. A little bit maybe lower horsepower construction dealers, just to really supplement what they're getting, obviously, from their captive insurance companies, or try to maybe stretch out some terms, or a little older in equipment, or just kind of be there to fill in all those gaps. And so been doing that for quite a while. The finance side of it obviously was started a little bit later, 2018. We started kind of doing a little bit with the finance side, and the philosophy was obviously to basically do the same thing. Really go out there and try to fill all the gaps that maybe a captive might not quite be filling, and then be able to really kind of provide a service to the dealer, other than being just another lender or bank out there. We wanted to create an opportunity for them to have their own finance division. And even if they had their own finance division, to be another outlet, to some of the larger dealers out there, where we could, do some soft pulls on credit history, and give them guidance on where to go and what to do. And luckily we've been able to, contract with about 35 different lending opportunities out there, giving us, a pretty wide array of construction equipment lending, ag equipment lending, titled equipment lending, and then try to cover all the different gamuts of credit out there. You get a lot of differences in credit, and a lot of that's revolved to economic conditions and everything. And we may be running into some of that right now. We'll see what happens as we go, but we wanted to be able to provide, the best of the best on A credit rates, if we could, be extremely competitive there, all the way down to stuff that might be a little bit more difficult to get approved. They call it maybe more of a subprime credit. But in reality, it's, as things have grown over the past few years, and more dealers are on the platform, it's become kind of a go-to, where they feel like they can just kind of wash their hands of it a little bit and keep selling equipment the way that they would like to sell equipment, and not have this, I guess, dominant.
Right on. All right, so let's talk about what's going on in the environment. So you had a CPI report come out today. Stock market's all excited about that. And then you got the Fed meets again tomorrow. Tomorrow will be what is today, 13th, 14th. So it'll be December 14th. They'll have their Fed meeting. They'll release their stuff. Everybody will come through it. And by Thursday morning, the world's going to probably come to an end again. So that until Friday, then it'll all bounce back. But, as you're looking at what's going on right now, they're all intents and purposes, it looks like they're going to see a half percent rise in rates again. So right now you're seeing a lot of 7.25 to 7.75 range stuff out there. I guess as you look at this, Troy, and you're kind of picking your brain here a little bit about what's going on. What's your gut reaction to seeing an 8% interest rate or a 7.75% interest rate on a pretty regular basis now?
Yeah, I really think, I mean, you kind of hit the nail on the head there. I mean, I really can't see it not being somewhere in that range here, somewhere in the near future at this point. I think with the Fed meeting, like you said, today and tomorrow, they'll release, what, I guess draws everyone's attention is that Fed funds rate that they're going to set, which is it's the guidance is what it is for banks to lend to each other, on a nightly basis on reserves and borrow if they don't have the reserves that they need, obviously, to keep their percentage up. It's determined by the Fed, but that's gone up, what has it gone up 3 or 4 points here just in the last, 6, 8 months, 9 months altogether. So that real cheap money that we saw, before, we saw it for a long time. So everyone gets really used to that. I mean, it's just like fuel prices, all of a sudden they start rocketing up and people get all worried about it. And in all reality, interest rates right now, if you look historically, are still actually, really not that high compared to where they have been, in previous times. It's just, I think we've got used to those really low rates. And of course, I mean, let's face it, the lower they are, the easier it is, obviously, to produce a profit, for a lot of people out there borrowing money. Right now they're sitting at 3.75 to 4% roughly for that Fed funds rate. And I think the biggest issue that they're trying to solve for is obviously to, circumvent inflation right now. And I think they'll continue to probably look at raising possibly that rate until we see, some backtracking on some of those inflationary numbers. They talk about this, inverted curve, where we got long-term rates, 10 years, compared to, say, a short-term rate, a 2-year, which are dropping a little bit quicker than what the 2-year were just recently. You look at those mortgage rates, and they've actually gone down about 3/4 of a point over the last month and a half, but you haven't seen that much flexibility on the short-term rates. And so I think they'll, I've read a lot of speculation on it. I mean, speculation is probably eventually for them to maybe tap out somewhere around that 4.5, 4.75, 5 rate. So I think we do have a little bit more. The big thing will be if they do come out, like you mentioned, and it's a 1/2 point instead of 3/4 of a point, because the last how many times, it's been a 3/4 point increase each time. If it's a 1/2, there's a little bit of, all of a sudden, a little bit of a sigh. I mean, things are still going that direction, but at least we're starting to feel like maybe there's a little bit of a top out at this point. And I think it's, I think it's probably pretty inevitable that there is recession coming. It's just a matter of how difficult is it, how long is it going to last, and hopefully right now, maybe those, even if those rates do get to that level, which, like you said, if you're looking at rates in the 7s now and fall a little bit, I think we're probably at our top end. I'm hoping at that point.
Yeah, I hope so too. Hope you're right. All right, so what are you guys doing over at Machinery Scope right now? I mean, what are some of the stuff that you're doing? I mean, you're I guess kind of define a little bit what it is that you're doing there. I mean, it's not an average run of the mill like type of lending institution. You guys got some different packages and different groups of things that you do, but you're primarily playing on the lease side of stuff. Is that correct?
I actually do both finance and lease.
Okay.
And yeah, you bet. Bet. Yeah. So we like I said, our big thing was to try to create one spot for either finance companies at the dealerships or the salespeople that they could come to and have everything, from one lender to 35 lenders, with the guidance obviously in the background to try to assist on where to go, because it seems like every lender out there, or finance company out there has got some sort of different regulations or I guess probably stances on credit that they would rather see come across. You have your real solid A credit players out there, and then you have some that allow, maybe a little bit of what we would call more of a B plus or a B credit tier, where it just doesn't quite maybe hit that, say, 700 mark in credit. If we were going to relate it, maybe they're just a little underneath there, maybe a couple 30-day late payments or something, but still should be able to get an approval somewhere. And it's a matter of finding who likes the ag business, who likes the construction business, who likes it with a little bit more cash down, who will take it without any money out of pocket at that point, who's going to specialize a little bit here or there. So without everyone else having to try to figure out where those places are and the best places are out there, we've contracted and we've been able to kind of sit behind here and be able to just kind of act as kind of the expertise in that area and say, hey, we've got the platform. We can create the credit application links that are customized for each dealer group. You guys can carry them on your websites. You can email them. You can text them to customers. They can fill out applications electronically. They can figure things out on our app that we have out there at that point. And when they come over, we're able to take a quick look and do a soft pull credit pull. And a soft credit pull, as a lot of people understand, does not hit your credit report. It's something that's very similar to maybe what an insurance company will do when they're renewing a policy or something like that out there. They may check it, but it's not going to hit your actual credit report. So we can get a pretty good idea of where that's at and the best place to go, and probably narrow it down to the top two at that point, and really probably either take it from there or just kind of stay behind the scenes and let the salespeople or the finance division run with it. A lot of that, nowadays we see is all involved in eDocs.
Right.
So eDocs is the next step, which is very easy. It's a matter of getting funding instructions, from the dealers, and then we kind of handle all of that for them at this point. And the real neat thing is, as being, I guess, having as many dealer groups as we have on the platform, there's a lot of volume that's being driven towards some of these lenders. And of course, when you have 35, you don't use all 35. I mean, you do have your favorites and you have the ones that are the best, I think, out there right now. And then you have some backups for certain situations. And when we're driving that much business towards those specific lenders, a lot of times we can get opportunities or programs with them that we've been able to negotiate on behalf of the dealers to be able to draw down those interest rates a little bit. Right now, like you said, I mean, a lot of the talk is sevens out there. We actually have got rate capability in the lower sixes, middle sixes right now on ag equipment, and can go out 6-7 years at this point. Same thing on the construction side of the business. We're able to, I guess, the last probably 3 to 4 months since we've seen this increase, we've had a couple opportunities be able to hold tight for us and just create special programs and keep our rates a little bit lower because of the volume that we're sending at this point. And so it's made a big difference. And like I said, I think we've gotten to the point with some of the dealers where it's just kind of a, hey, we got the app, we're sending it over here, you guys handle it. Let us know when it funds at this point. And if you need anything else from us, give us a holler. But have kind of, I guess, maybe replaced a little bit of what they've had to do in the past, and then also kind of assist in gaps that maybe the finance team might need just a little bit of expertise on, or maybe another option out there that we can kind of push forward. So The rate opportunity for us, for a while there when we first started, Casey, it was interesting because we could maybe match or be right around there with an A credit player, but we were getting a lot more business maybe on some of the stuff that was not being approved by the A credit players out there, the natural go-tos in the industry. And as we've grown and built more volume, we've been able to now, be able to negotiate some of those opportunities with some of those lenders. And now all of a sudden our rates are actually showing up anywhere between 0.5 to sometimes 3/4 of a point better than the A rate players out there. So it's that happens obviously with volume as you go. You can't do that initially right away up front, but it's been real interesting, and we've seen quite a bit of growth obviously from day one, but this last year has been a doubling in business, and so it's exciting for us. I mean, we're obviously trying to make sure that we're turning things around as quick as possible, and adding people where we need people at that point. But it's an interesting time in the market too, right? I mean, you're looking at a lack of inventory and rising interest rates, and so it's there's a little bit of a pullback, but it seems to me right now, and I don't know what you're seeing, but seems like there's money out there. It's just a matter of making sure that they can, I guess, find the right inventory, before it gets swallowed up. So
I think that's exactly right. I mean, you're looking at what's going on out there with equipment, and there's, like you said, there's plenty of money out there right now. Our guys are really looking at what their options are and what they have available. And and what they're looking for is not necessarily what's available. And I think that's the biggest stumbling block we see right now more than anything. What I see happening is we see a lot of 1-year-old, 2-year-old, low houred stuff out there, and that's great. It's awesome. There was a need for that stuff, and we've got that filled up. We've got the people that are interested in doing those things. The issue that I think we're running into is that we have really low houred stuff and really high houred stuff and nothing in the middle. And
Right.
and I think what I'm feeling, and I would like your opinion on this, what I'm starting to feel a little bit and what I'm starting to see a little bit is very similar to what we saw with the lease craze in 14, 15, 16, 17, all the way through up to 20 or whatever, where we looked at a lot of leases and we were selling a payment. We weren't selling necessarily the price of the machine. And I think we've always done that to some extent, but now the forefront of what the machine cost is really in people's minds right now. So I think we're going to revert back to that with high interest rates and what that does to the payment structure of the machine and what that looks like, and then the long term, 5 or 6 years down the road, what's this, the interest that you're going to pay and all those kind of things. It feels like to me we're slipping back to that. We got to be creative and start thinking about payment structures and what that looks like. Are you having those kind of conversations, and are you feeling the same kind of thing that I am?
Correct. Yeah, I think the leasing requests as far as quotes have gone up actually over the past, say, 30 to 60 days.
Mhm.
And so I think you're right in regards to that. What's going to be interesting though is where do the banks or the leasing companies, where are those lease residuals going to fall into play? Because I think
Yeah.
before, when we talked about that early run, the 14, 15, 16, like that, I think residuals were they probably a little too high, probably in regards to, looking out. I mean, who would have foresaw what happened at that point? But the issue you run into there is all of a sudden prices dropped like crazy, and then these leases were coming due, and everyone was turning these pieces of equipment back in, and the banks and captives were sitting here with all this equipment, and prices on these pieces of equipment were quite a bit lower than what they were holding at. And so I think they're going to look at that and they're going to say, hey, we don't want to get ourselves in that situation again. We definitely want to move equipment and we want to definitely move new equipment. But at the same time, are they going to be able to, carry those higher residuals? And I don't know if you necessarily need the higher residuals like you had. It seems like, we're still doing leasing, up to this point on in the popular area. I think obviously has been right in that, probably 1 to 4 year old piece of equipment. Maybe you're sitting underneath 2,000-3,000 hours or something like that on those pieces of equipment, and you've still been able to get some pretty decent residuals on those. So we've seen a little bit more of that happening. I again, it's what the auto industry kind of perfected for a
Mhm.
while there when they said, we really shouldn't be selling on interest rates, which we do a lot of, and we push a lot of out there, and they decided, hey, what really seems to get things moving is payment options, and when you can break things down to cost per hour, cost per acre, instead of a dollar sign, instead of what that interest rate is. It's because let's face it, if you look back, when we first started talking about these rates started going up, I took a look the other day in March of last year, and I think our rates were sitting in the upper twos.
Right.
So all of a sudden, I mean, you've more than doubled where you're sitting at right now, and a lot of guys will want to pull back a little bit, but yet if you've got that cash out there, there's still probably something they need to do with that by the end of the year, and maybe even into next year at this point. So I do think that's something that they will come back to. It's just a matter of where are those residuals going to be at? Are they going to be competitive enough? The other thing that I think will maybe slight that just a hair is the bank's natural feeling. I think when rates start to rise like that, of maybe pulling back a little bit on credit, right? So I think they're starting to kind of tighten up a little bit more. I think you'll see that. I took a look at a report the other day that had November Chapter 11 bankruptcies, and they were up 74% compared to last year, November. Now,
Mhm.
that's just a number, but at the same time, what that usually does to banks is they kind of go, well, wait a minute, maybe we need to really kind of recondition on what we're looking at and what we're buying. And so it's going to be real important, I think, for the dealers out there to be able to have a pretty wide variety of options at their hands, right? So they have a number one or number two, and those number one and number twos decide to tighten up a little bit and maybe not, do as much in regards to that leasing end of it. They need to have some other options or need to have some other, outlets out there that they're going to be able to get these things done at still. Otherwise, the people who might be sitting next door, who are using those, are going to swallow that business up. Because like you said, it's not necessarily so much about, the equipment isn't prevalent, right? And it seems like everyone's looking all over the country for equipment. And it seems there's some out there. It's just a matter of, are we able to get these things done the way we have in the past? And so it's nice to have that bucket of different options that you can have no matter what happens with the credit when it comes to that.
Right. Excuse me. So I think if you look at moving into 23, I think you made a good point there where our banks are going to start taking a hard look at a lot of the stuff, a lot more, a lot more intrinsically than they've looked at stuff in the past, right? It's easier to get away with stuff when you're lending money at 2.5%, not 6.5% or 7% or 7.5% or something like that. So that money really jumps up there quick. What are your thoughts on 23 and how do you see things kind of moving along? I mean, I feel like 23, there's going to be plenty of opportunity out there to look at some stuff. There's some big crops. We talk about a lot of big crops all over the world. But we're also having a lot of struggles right here, right now, just getting the stuff that we need to have taken care of to happen. So I guess as you look at 23, what are your thoughts there? And how do you foresee your lending options, kind of playing into that?
Right. And I think, it's interesting when you talk about the lending options too, there's a couple different kind of lending options out there. I mean, you have your lenders who are banks who are able to borrow, from the Fed at that point, and they're able to borrow at maybe where that Fed funds rate is at, et cetera. And then you have your others that aren't necessarily Fed funds banks that are finance institutions that are trying to, borrow from a warehouse line, or maybe they're trying to borrow from, an asset-backed security that they've offered or something like that. So those rates tend to get a little bit higher. So you'll see some differences. I think there's a little bit of a gap. I think we've already seen between some of the banks out there and others, just because of who they're borrowing their money from at that point. So that'll probably play a lot into 2023, who's going to be getting that business. So again, a real good thing to have a larger opportunity or a larger group in front of you to be able to take advantage of that. To me, and I'm not the expert. I'm not the one who's going to obviously make the decisions, Fed level or anything like that whatsoever. But I definitely think that, until inflation starts to go the other direction, they're going to hold. And from, what we've studied and read, we see, that carrying for a little bit longer. I don't think it's going to go up and then come back down again right away. I think you're going to see these things. Maybe I'm hoping, maybe they can start tailing off here into the beginning of this year where the increases stop. But then I think you're probably going to see that rate level held, for a while. I've seen people and I've seen investment articles in regards to where people think the recession is going to hit a little bit in the beginning of the year and then things are going to pick back up. And then I've seen others say, no, it'll hit towards the beginning of the year and it's going to carry, through 2023, based on that. But I beyond that, I mean, obviously it's very difficult to predict anything, but I wouldn't expect, and again, this is just my opinion, I wouldn't expect to see those 7-8 rates that are going to be there and happening come down much quicker in 2023. I do think that it's going to be kind of a little bit of a new norm, as they may call it, for a year or so, and then we'll have to see what happens in regards to the inflation side of it. And like you mentioned, there's cash out there. So I think the buying is going to continue, even though the rates are going to be a little bit higher. I mean, I guess it's the same thing as fuel to me. You see those fuel rates go up and people still do what they need to do. They still drive around. They still get from place to place. It's a necessary evil. They'll reduce a few things here or there. So I don't see it, cutting decisions off, really large. It's just the other piece of that puzzle, obviously, is how quick the stuff get produced, at the factories. So we're able to continue this, this role of one to the next guy because like you've alluded to on many other podcasts and everything too, that trade cycle, the whole thing gets broken up with not having that new piece of equipment able to move to that guy that's buying that, and
Yep.
that trade going to the next and the next. And so it's not affecting just one transaction, it's affecting five in a row. So if we can get more of that produced and that can loosen up a little bit, I think the interest rate part of it will kind of die down in regards to being that important. It's always going to be important. Guys don't want to borrow money when it's a little bit higher than a little bit lower, but at the same time, business does go on, and I think we're still going to see a decent amount of purchasing, and like you said, probably maybe a little bit more leasing to offset some of that, and some guys that may want to just lease for a few years and wait to see what happens with the values of the equipment, and if they're in good shape and the values are still high, great, they got equity in it. If they don't, they're able to maybe turn it back in at that point. The price you pay for a walkaway lease though is quite a bit less residual.
Right.
So I still haven't seen a lot of requests for that yet. I see a lot of requests for, pro leases or First Amendment leases or track leases at this point where, they're probably going to buy it out just to be able to keep the residuals high enough. But I think once you start seeing more and more people want to take advantage of a walkaway lease, then that's when you'll start to see more of that adjustment, when we'll probably see a little bit higher percentage of customers out there. And a lot of it has to do with how we present it at the dealership too. Are we out there presenting that to the customers, or is it just the finance end of it? And I think the guys that are able to present both those options are the ones that are always going to win. When it comes down to it, you just got to know where to go and how to handle it and understand that piece of it and be comfortable with it, so you're putting your customer in a good position.
Right. All right. Last question here, and then we'll hang it up here. When you're looking at, I think the one thing that I would say is a kind of bit of a moniker, I guess, on my radar here is upgrade kits and what that looks like, whether it's a precision plant stuff or Deere's upgrade kits for their planters and sprayers and those kind of things. Technology, additional technology you can add on those kind of things. I foresee that there's going to be, less powertrain actual like turnover from a customer to being sold, and way more of this, upgrade kit stuff put together on there, and how those things come together. From your perspective and what you're seeing happen on the lending side of it, are you seeing more guys looking at, hey, I'm looking at taking my planter and making it new again type of thing? And hey, I'm looking at these little, additional, whatever technology add-ons of sorts, whether it's guidance systems or whatever it might be. How are you looking at that, and how's that fitting into your portfolio?
Correct. Yeah, we've actually seen some requests for just guidance systems, which we've been able to, as long as generally, and a rule of thumb, a lot of times, as long as there's a serial number involved, that's something that we can handle pretty easily in regards to being able to finance that on its own. There's a lot of lenders out there who want to tie that directly to the piece of equipment too, and make sure that that's held for collateral. But then there's others that'll just say, hey, yeah, as long as we got the serial number, we're okay just actually, using that as collateral, to back this loan at this point. Or so I think you're right. I think there's, there hasn't been a huge amount, but I think there's, and I think we probably felt it this last year. It seems like there's a little bit more of a race now to get to, that autonomous tractor at that point, or autonomous equipment, or different things that I believe are kind of pushing that further. And I think our big players in the industry are really, not that they haven't been to everyone, because there aren't enough of them being produced. They are going to try to be able to probably they're going to tie in some sort of in between that they can do until they're able to get their hands on that equipment, and that might be adding on some of that guidance equipment, et cetera, that I think are going to help. So it is definitely something that can be set up on its own contract. And so, I guess when it boils down to it, if you've got someone looking at, not necessarily maybe writing a check for something like that and keeping cash, being we all know cash is king during these times, it's definitely something we can assist with and set those contracts up. And it's a matter of the same setup. It's a purchase order. It's a serial number that's on it. It's a description and it's an application and it's taken care of just like the actual piece of equipment itself.
Right on. Okay. Yeah, it's something we're seeing more and more of, where they're wanting to do some more stuff like that when it comes to technology. So, well, Troy, I appreciate you being on the podcast, man. If folks want to reach out to guys over at Machinery Scope, Machinery Finance, is the best way to do that?
Sure. Hey, best way I think would be to just get to our websites. Obviously, those are www.machineryscope.com, and then the finance is obviously the same thing. It's www.financescope.com. We've got a couple 877 numbers that they can reach out to if they want to reach out directly to the Finance Scope side and ask any questions or need any assistance. That number is 877-687-1444, and we'll be happy to answer any questions, take a look at anything. Just like I said, be kind of in your corner and try to get you guys some assistance to move more and more equipment. Even though we're running into some pretty challenging times. So.
For sure, man. Well, appreciate you being on there, man. Looking forward to seeing you guys Moving Iron Summit coming up here in September.
We'll be there.
Right on, man. Okay. All right. I am Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Also, go to Moving Iron Podcast on LinkedIn and check the video version of this out at Moving Iron LLC. I'm sorry, Moving Iron Podcast on YouTube. So check it out there. So go to Moving Iron LLC for everything Moving Iron related. And with that, I'm Casey Seymour with Troy Vosberg. With smart folks. Out.
Moving iron in the 21st century.